Welcome back to The Explainer. Today, we're unpacking a massive topic, the high-yield trap, and how you can actually build monthly income safely. We're talking passive income, the nuts and bolts of generating real monthly cash flow, and most importantly, how to dodge those incredibly dangerous yield traps that literally destroy so many portfolios. Let's just get right into it.
So what if your money paid you every single month, even while you sleep? Okay, let's dive into this. Just imagine waking up, pulling up your brokerage account on your phone, and seeing cold, hard cash deposited regularly. And the absolute best part? You didn't even have to sell a single share of your investments to get it. That's the true power of dividend investing, right there. It's really about transforming your money from this lazy thing that just sits in an account into a highly active employee working for you 24/7.
Section 1. Understanding dividend mechanics. Now, as we know, a dividend is just a portion of a company's profits paid directly out to its shareholders. But it's always worth remembering that this exact mechanism is how massive household names, think Coca-Cola, Johnson & Johnson, Procter & Gamble, have consistently rewarded their investors for decades. You're literally getting paid just for being a part owner. But, and I really cannot stress this enough, dividends are never guaranteed. The golden rule here is to always invest in financially strong companies. Because a struggling company, well, they can cut or completely suspend that dividend in a heartbeat if their profits dry up. So that establishes our critical baseline right out of the gate. Company quality absolutely has to be your #1 priority.
Section 2. The math behind the magic. Let's try to bridge the gap between abstract finance and your actual lifestyle here by walking through a real-world scenario. Imagine you've saved up and securely planted a $100,000 initial investment into a carefully constructed dividend portfolio. Next, let's just say this hypothetical portfolio you've built has an average, super realistic dividend yield of 4%. For anyone focused on income, this is a very common, very attainable target.
And here is where the math really turns into magic. That 4% yield on your 100 grand investment, it translates to about $4,000 a year. Break that down, and it's an incredible $333 a month before taxes. Think about that. That is a car payment, or a really solid chunk of your monthly groceries, completely paid for every single month, just as a reward for holding the stock.
Section 3. The high-yield trap. Right here is where we need to get very serious because this is an incredibly dangerous pitfall. Here is the ultimate warning. Do not chase the highest dividend yields. I know, the allure of that huge monthly cash flow is super tempting. When you start looking for income, you're inevitably going to see stocks offering these massive payouts, 8%, 10%, even 12% yields. It acts like this irresistible siren song. But honestly, chasing these sky-high payouts is the single easiest way to permanently destroy your investment capital. Just don't fall for it.
Now, what's really interesting to consider here is this fundamental conflict we're dealing with. It's the illusion of a high yield from a struggling business versus the reality of a sustainable yield from a healthy business. A massive yield isn't some hidden gift the market is secretly handing you. Actually, it is almost always an enormous, flashing red warning sign.
Let me break down the exact math behind this trap, because it's fascinating. Say a struggling business is failing, right? Investors start to panic, and the stock price absolutely crashes over a couple of years. Well, because a dividend yield percentage is calculated by dividing the annual payout by the current stock price, a crashing stock mathematically inflates the yield. It looks huge on paper, but you aren't finding a hidden gem. You are looking at the artificially inflated yield of a sinking ship. That payout isn't sustainable. Soon, the dividend will likely be slashed to zero, leaving you with devastating, permanent losses on your original hard-earned capital.
Section 4. The triumph. Quality over yield.
So how do we actually navigate around this trap? We resolve this whole tension by shifting our entire philosophy. We have to focus on the underlying health of the business, rather than just staring at that shiny payout percentage. You really need a strict checklist to identify true quality. First up, strong earnings. The company needs to be genuinely, consistently profitable. Second, healthy cash flow. They literally need actual cash coming in the door to pay out to you. Third, sustainable payout ratios, meaning they shouldn't be paying out 100% of their profits. They need to keep some in the war chest to actually grow the business. And finally, you want to see a long history of them consistently increasing their dividends over time. Trust me, quality will always beat a flashy yield when you're trying to build reliable, long-term income.
Now, once you actually find that quality,
You absolutely must protect it through diversification. It's the oldest rule in the book, but you shouldn't put all your eggs or all your money into just one sector. You want to spread your investments securely across different, stable areas of the economy. Think healthcare, utilities, consumer goods, energy. That way, if one sector experiences a sudden downturn, the others are there to help anchor your portfolio and protect you from that wild volatility.
So let's break this entire strategy down into 4 totally actionable steps. Step 1, invest in high-quality companies with bulletproof financials. Step 2, diversify across those different sectors we just talked about. Step 3, consider monthly dividend ETFs. You see, most individual U.S. companies only pay out their dividends quarterly, but by utilizing monthly dividend exchange-traded funds, you can actually have those funds distribute income to you every single month, which makes budgeting so much easier. And finally, Step 4, reinvest those dividends while you're still in the phase of growing your portfolio.
Section 5. The compounding effect.
And this brilliantly illustrates what happens when you take those monthly payments and use them to buy even more shares. This right here is the long-term secret weapon of successful investors. But you always have to remember this one thing. Dividend investing isn't a get-rich-quick strategy. Actually, scratch that. It is the exact opposite of a get-rich-quick scheme. This strategy requires absolute patience, unbelievable consistency, and a relentless focus on quality. By reinvesting your dividends, you trigger a compounding effect that significantly increases both the total value of your investments and the size of your future monthly income. And the best part? You do it entirely without the massive stress of constantly trying to time the market.
So I want to leave you with this final, provocative thought to chew on. Are you just chasing quick yields, or are you actually building lasting wealth? Remember the high-yield trap we talked about today. Don't let yourself be seduced by the illusion of a failing company's massive payout. Focus on patience, focus on quality, and just let the math do the heavy lifting for you over time. Thank you so much for joining me for this explainer. I really hope it completely transformed the way you view passive income. Catch you next time.